I wanted to open up by asking Mr. Neff a question. In your testimony, you talked about the large investments made by a small group of venture capitalists. Can you further explain why venture capital is so important to the economy in context with how what you do is different from the big buyout groups and the hedge funds?
That's a lot to chew, but I'll give it a try. When we come upon an investment that interests us, it typically has gotten either a terrific group of management around it, if it's a raw startup, and the idea is so compelling that we invest a lot of time and a lot of consulting help and a lot of effort in trying to understand the opportunity. And then when we do decide to try to put together a group of venture capitalists to actually form a syndicate to make an investment, at that point we give birth to that company, or if it's a company that has been funded through the angel networks or through other programs, we then bring another round of investment intensity to the company and help to propel the next stage of growth. The importance is that our companies are receiving our capital in order to invest in research and development, or in order to invest in job growth, and in order to invest in economic growth. These companies were not generally using any of our capital to pay off other shareholders, to buy positions of ownership from other shareholders, to repay debt, and those kind of things that are shuffling the financial deck, if you will, but not being invested in core economic growth. So I think that that venture can be contrasted from the buyout firms in that regard. And now I don't mean to contrast ourselves unnecessarily from firms like PAM's, because they invest so much in growth equity at a slightly later stage than we do. But I think that there is definitely, from a policy perspective, in my mind, there is a real difference between firms who primarily invest in job growth and in fueling company growth when compared with firms that generally invest in highly leveraged transactions and reshuffling of the financial deck.
Thank you. And I'm going to ask another question. I'm going to turn it over to Ms. Fallon. For this question, I would like all of your opinions who have an interest in answering. I'll start with Mr. Neff since we're on him. And in your testimony in particular, you focused upon the President's proposal to apply no capital gains tax for investments for small businesses. And from your perspective and the investment of the entire panel, how broadly should this tax be applied in order to maximize its benefits to the small business community?
I think there will need to be a lot of discussion in terms of what the parameters of its application are, but I think that if we can adequately define what a small business is, and we can adequately define the purpose of the proceeds of the investment so that it creates jobs, so that it creates funding for research and development and early commercialization activities, I think that that is where that tax incentive ought to be focused. If it's focused instead on things that are less productive to economic growth, then that's where it ought to be cut off.
At the Angel Capital Association conference summit that we had last year, about 380 accredited investors representing the different groups, all of us were there. And this is herding cats. These are all very interesting people, but they all have a lot of opinions. The one common public policy position we came up with that everybody agreed on was low or no long-term capital gains, and we'd be very happy with the venture capital standard or whatever. It's time that makes a difference to us. So whether you make it 2 years, 3 years, 5 years, to have zero capital gain, that's the key thing that will keep angels, we believe, continuing to invest in startups.
I would just echo the other comments that are made. It's a definitional issue on what is a startup or a small business that really needs to be defined, and then the use of proceeds, and make sure that the infusion of capital is for economic development purposes. And the time factor on the capital gains is really key to investors.
I agree with that. I think it's the time factor, and obviously private equity has been a little bit at the vortex of this in terms of the carried interest discussion. But, you know, when you think about what we do, we're putting both our money and our sweat equity into a company that makes chimneys, and we're working with that company for 5 years. So if that's not a capital gain, I'm not quite sure what is.
Ms. Mott?
If I might add, it's more than the time frame element here at risk. We're competing with a 0% capital gains rate in Hong Kong, Singapore, China, the other parts of the world. And if I don't think we can keep up with innovation and funding innovation at the same rate if we can't keep attracting capital. And I think it's a very critical point. Thanks.
Mr. Dalton, you have anything to add?
Yeah, we're a lender. We have 90,000 public shareholders, so this is the conversation for our business is not relevant. However, I hear the panel's point. I think it's a good one. Private equity in general does put a lot of sweat equity. It does, take a lot of time. And small companies, we have the benefit of seeing small companies get to a later stage and become middle market companies. So I think that it is a worthwhile discussion that ought to be had, and not necessarily carving out specific groups.
Thank you.